Okay, students, today I'm going to explain about the stock market and we will understand some of the important points related to the stock market and what is ETF, what is the mutual fund, and what is bond and many more things. And how we can say that which stock is performing well and which stock is not performing or underperforming and which stock to buy and how we can buy some stocks. So all these are important informations that will be covered today. So first of all, that if we want to understand something that we should know what is the stock market. Everyone these days that they just saying that market is up, market is down. But what the market is actually, what the stock market is, what is stock actually? Stock, sometimes we can say share, right? Or sometimes we can say securities, or sometimes we can say stock, right? So the stock market is a marketplace, right? So where like some players are there, like investors, and investors they can buy and sell shares. Uh, they can buy and sell shares of for what, like so what kind of company? Publicly traded companies only. Some companies are publicly traded, right? So for those companies that stock can be bought and sold in the market, right? Uh, and if it facilitates the exchange of companies' ownership for capital. What does it mean? It means that it helps. It helps in buying and selling of stocks, right? Through the stock market. And the purpose of this is it helps company to raise the capital. For example, that if company have lots of stock, right, and they want to generate money, and people buy some stock. Let's say take an example of Tesla. We buy Tesla stock. So where this money will go? This money will go to the Tesla company. Let's say today that I'm just buying $10,000, I'm spending or $5,000. Not only me, all over in the world, many people are spending a lot of money. Once they will spend money, that whole money will uh, go to Tesla company, right? So, what is the purpose of generating this amount or capital? So they generate this money, and also after generating they invest more, and whenever the profit they earn, the profit will be distributed among the shareholders. For example, that I have invested something like $5,000 and I'm also the owner of the company to the specific number of shares, right? So the stock market, it helps the companies to raise capital to grow their businesses and provide investors with opportunity to earn return on their investment through capital gain and dividend. So capital gain and dividend is a different thing. Capital gain means like if I buy stock at 100 and then the price is 200. So if the price is 200, so it means the price has increased. And if I sell that stock, then the $200 that will be the value when I sell. The cost price was 100 and 100 will be the profit, or that profit is the capital gain. Okay, if there is a capital gain, keep in one thing in your mind, capital gain. So due to capital gain, the $100 that will be the taxable. So the tax will have to be paid by the company, right? So that is the taxable amount, right? Okay, and dividend. What is the dividend in this case? So dividend is, let's say company have earned a profit. Like I can show you here. Let's say, okay. So let's say company have earned some profit. I can show you in Excel sheet. Let's take an example that company have a profit of 12,000 and a company declare dividend of 2,000 and the rest amount is $10,000, right? So this is the dividend amount that company have. So the dividend will be distributed among the shareholders. So this is dividend and this is the profit of this year. And after dividend, this is retained earning. So this retained earning will be remain in the company for the further investment, right? Okay. So next is now if you talk about the stock exchange, what is the stock exchange here? New York Stock Exchange. This is one of the largest and oldest stock exchange in the world. Not I'm talking about in USA only, but in the world. And this is known for its strict listing requirement. They have very strong listing requirement. What is the meaning of listing requirement? For example, that I have my company and the company name is Go East Travel, and I want to list this company. And if I want to list this company in the National Stock Exchange or New York Stock Exchange, then I have to have some requirement. I have to fulfill all the requirements. There are strict requirements, right? This much should be the capital and all that. Second is NASDAQ. NASDAQ is a high-tech and growth-oriented companies, and it operates electronically rather than through the physical trading floor, right? So NASDAQ is also one of the stock exchange. TSX is the Toronto Stock Exchange. This is also a very big and large stock exchange in Canada, right? And featuring the wide range of Canadian and international companies. So what are the function of all these stock exchange? They provide a regulated platform for the trading securities, ensuring the transparency and the liquidity. So it provides the platform where you can buy and sell stock. Means trading. Trading means buying and selling. So buying and selling of securities. Securities means stock. So different sectors in the stock market. Yes. So if we are going to understand about the stock market, we should know about the different sectors in the stock market. So different sectors are technology, healthcare, finance, consumer, discretionary, and energy. These are the main sectors, right? So the technology sectors involve software, hardware, IT services, healthcare, pharmaceutical, biotechnology, and medical, finance, bank, insurance, and investments. Consumer discretionary, retailer, Costco, for example, automobiles, entertainment companies, energy, oil, gas, and renewable like Fortis BC, Hydro, and other related companies. So these sector performance can affect the overall market trend and investment strategies. Now, you can note it down. What is ETF? ETF is exchange traded fund and is an investment fund that hold a diversified portfolio of assets such as stock or bond and traded on the stock exchange. The feature of this ETF is that offer diversification. Diversification means that you are going to diversify your risk. And what I say, these ETF are also traded just like the stock and generally have lower fees as compared to the mutual fund. Now, there are two things, mutual fund and ETF. Before understanding the mutual fund and ETF, I just would like to give you one example. Let's say if you go to the sweet shop and you want one type of sweet, let's say like maybe burfi or maybe some others sweetish, right. So there are maybe one, two, three, four, five types. If you take a box, instead of like taking only one type of sweet, you are taking five or six type of sweets in one box, and costing that will be same, for example. So that is what you have done. You have diversified, you have more options. You can have like you can taste more dishes, right? More sweet dishes, right? Same thing, another example I would like to tell you about stock. Stock. It means if you want to buy stock, don't invest in one stock. So don't put all egg in one basket, right? So what does it mean? If you will be putting all egg in one basket, if the basket fell down, all the eggs will be broken. So if you have your hard-earned money like $10,000, you are investing $10,000 in one stock, let's say in Tesla. And if that's something happened bad with the Tesla company, your all money will go. So better not to buy one stock, better buy bunch of stocks. So bunch of stocks can be bought in the mutual fund that only and only bank will operate. You cannot buy mutual fund by yourself. You have to go to bank and they say, I just want to buy mutual fund. They will ask some questions about your target and everything and your income, and they will set up your account. And every month from your account, $500, for example, it will be debited automatically. This is auto debit, which is known as SIP, which is known as systematic investment plan, SIP. Okay, so in that case, bank charge some money from your profit you earn. In ETF, no need to go to bank. You can do it by yourself. You need to you make one account, right? So how to make it? What are the application? I will explain. And no difference at all in the mutual fund and ETF. But ETF is much better than this. The difference is only that ETF that you have to see that which ETF that you are going to buy, and sometimes you have money, sometimes you don't have money. So sometimes you buy, sometimes you don't buy. But in mutual fund, you have to arrange $500 every month. So every month investment will be going on. Here it's upon you. Sometimes you don't invest, sometimes you invest. Now there are 5 ETF. So there are 5 ETF, which are very, very strong ETF here. So these ETF you can see here. SPDR or SP500. SP500, which is known as SPY, track the SP500 index representing the large cap US stock. 500 stock index is there. If the market is up or market is down, you can see the S&P 500, which is the code is SPY. Next is Vanguard Total Stock Market ETF. This is also one of the ETF which is representing by VTI. And the next one is EEM. These are some of the examples that I'm just giving that focus on majority of the emerging market. Next is Investico Triple Q, right? So that is a 100 Nasdaq 100 index, which include top tech stock in USA. Vanguard is a VEA, is invest in the developed market outside of USA and Canada. So these are some of the examples of the top ETF. Now, what is mutual fund? A mutual fund is an investment vehicle that pool money from the multiple investors to purchase a diversified portfolio of the assets managed by the professional. As I explained, it's the only bank will use, and you have to go to bank and you can invest in the mutual fund. So mutual fund provides a diversification and professional management. It is managed by some professional, but may have higher fees and less flexibility as compared to ETF. Now, top mutual fund is the same like Vanguard 500 index, Fidelity, then Row Price Blue Chip Growth Fund, American Fund, and SP 500 Index Fund. These are the name which is created by different financial institutions. Like financial institutions, what does that mean? It means Scotia Bank, TD Bank, then CIBC Bank, right? And we have Bank of Montreal. So Scotia, Bank of Montreal, RBC. So these are main 5 banks that deal with the mutual fund. More banks are financial institutions are also there. They deal with the mutual fund as well, and they prepare these kind of products. These are the product for them to sell. What is bond? Bond is a fixed income security, right? Those people who just want the fixed income security, they don't want to indulge into the more risky thing. But this is the bond is the less risky, which is issued by the government and big corporations. So bonds are typically less risky than stock and provide regular income, but the returns will be very low, maybe 5% or 7%. Individual stocks like Tesla, Microsoft, Nvidia, AMD, Costco, These are the individual stocks, represent the ownership share in the single company. Investor can buy and sell these stock to gain from the company's performance. And investing in individual stock can offer high return, but also high risk as well. Top 5 stock in USA is you can note down these 5 stocks, right? These are the top 5 stocks in USA. Apple, Microsoft, Amazon, Google, and Tesla, right? So next is in 5 individual stock in Canada, RBC, Royal Bank of Canada, TD, ENB, Enbridge, which is related to oil and gas pipeline, Shopify, and Canada National Railway, CNR. Risk factor in the stock market, market risk. What is the meaning of market risk? Credit risk, liquidity risk, interest risk. Market risk means the possibility of the losses due to the overall market decline. These days, what is happening? So what is happening these days? Due to the tariff which is imposed by, if it is more by the USA, the Trump, right? So USA, the Trump, like he have imposed lots of tariffs on the different countries. Retaliatory means in response to that, the other countries are also implementing the same strategies. So that is the market risk. I have some stock. For example, that if someone have invested like $50,000, and due to the tariff, like overall market, it's the overall market risk. So the market is overall, that is like 25 to 30% is down. So it means if the person have invested $50,000, then that will be around, like you can say, $35,000 is value, and $15,000 has gone down. Now in this case, what should be done? I think like no need to sell stock, have patience and keep that stock. Better not to sell, better to buy. Credit risk is risk that bond issuer will default on payment. Right? Sometimes bond issuers, if they will be default on the payments, then there will be a credit risk. Liquidity risk is not being able to sell the investment quickly without affecting its price. So for example, liquidity risk sometimes, if some people have bought a stock, they want to sell it, but now they don't want to sell it because if they sell it, there will be a loss. So this is the liquidity risk. Interest rate is the risk that changes in interest rate will impact the value of the investment and particularly bonds. If interest rate change, and there will be effect of the interest rate risk. There will be interest rate risk as well, right? So these are the something that now what is portfolio? Now coming to the stock market main point. A portfolio is a collection of various investment held by individual or maybe some corporation or institution. It includes assets like stock, bond, ETF, and mutual fund, like combination of all these things, right? So that is known as portfolio. Well-diversified portfolio help manage risk and can be tailored to achieve specific financial goal. If we talk about the fundamental analysis, what is the meaning of fundamental analysis? Before you want to buy some stock, that you need to have a knowledge of this fundamental analysis. This is the process of evaluating a company's financial health and performance by analyzing its financial statement, in industry position, and economic environment. So there are some important key metrics like EPS, earning per ratio, PE ratio, and debt to equity ratio. EPS is it measures the company's profitability, and PE ratio that valuation of metric comparing to the company's share to its earning per share. It means PE ratios. I will also show you this PE ratio practically today. Debt to equity ratio indicates that relative proportion of the shareholder equity and debt used to finance company's assets. Company have bought assets of let's say $10,000, and the $10,000 assets are there. The assets will be financed by some from the capital, which is known as debt, and some from the equity, right? So debt and equity combinations. So money is is generated. Once the money is generated, and that money is spent on buying the assets. So that's why assets is equal to liability side. Imported in indices. So indices means like S&P 500 indices, Dow Jones, then Nasdaq, Toronto Stock Exchange Composite Index. These are the indices. Nasdaq Composite is the include 3,000 stocks and with a strong focus on technology. Nasdaq is related to the technology. Now, type of investor based upon the risk category. Some are conservative, right? So conservative means risk tolerance is very low, and their investment strategy will be they focus on preserving their capital. They want to save their capital and want to generate a continued flow of money and low risk return. So typical investment will be bond, high yield saving account. Like in the bank, they will deposit money. They will not buy stock, and they will also buy conservative mutual fund, right? Objective will be to avoid large losses and maintain a stable portfolio value. Right. So moderate investors. Moderate investors are like moderate, like middle, like not very low, but and not very high. Investment strategy for the moderate type of investors that will be between the risk and the reward and seeking a mix of growth and income. So typical investment that will be a mix of stock and bonds, balanced mutual fund and ETF. Objective will be moderate growth and controlled risk. Aggressive. Like some people are say, oh, I just want to be rich overnight, right? They have a high risk tolerance. If all the money has gone, they will say, okay, that I was prepared for this. I was prepared mentally. So investment strategy will be aimed for the high return through the investment with a high risk and volatility. So typical investment says individual stock, growth ETF, emerging market fund. Objective will be maximize return and accepting the significant fluctuation in the portfolio value. Speculative type is a very high risk kind of people, investors. Speculative investors. So pursued high risk, high reward opportunities, offering involving short-term trades. They buy like $100,000. They are just going to buy one stock, and in next day is maybe like $50,000 profit or maybe $50,000 loss. So that is a speculative type, very high risk. So typical investments will be like startup, cryptocurrencies, high volatile stock. High volatile stock means ups and downs, ups and downs. Yeah. So today market is up, next week may be very less. Again up, again less. So that kind of stock. And objective will be that investor want to have a substantial, means very big gain with acceptance of very big risk. So that is speculative investors. Now, if we say stock market and economics, so understanding the stock market and the different type of investor is closely related to the broader economy in several important ways. That's how this like the topic connected to the economic principle and factors. So capital formation and economic growth, like so stock market role and economic impact. So in this case, the stock market facilitate capital formation. Means capital. They want every company want to have more capital, more money by allowing company to raise fund through the issue of share. And capital that mean money is then used to invest in the business expansion, research and development, contribution to the overall economy. So whatever the companies are doing, and they are also contributing to the overall economic growth, economic impact. When the company grow and innovate, they contribute to increase the productivity, job creation, economic development, which boost the company. Market sentiments and economic indicators. Investor sentiments. When sentiments are positive, then market will be bullish. If the sentiments are negative, then market will be bearish. Economic indicator, as I explained, S&P 500, Nasdaq Composite reflect the performance of the large segment of the economy. The whole economy is going down or whole economy is going up. So these are the indicators, and indices are there which will reflect the overall picture of the economy. Risk and financial stability, investor risk portfolio, right? And economic implications. So three type of investors: conservative, moderate, aggressive, and speculative. Four types. Influence on the monetary policy. If we say monetary policy, this is related to the bank. It's related to the bank, right? So central bank actions like RB, Bank of Canada, BOC, Bank of Canada have reduced interest rate. So it also impacts the stock market. People have more money to invest in the stock market if the rate is down. Declining stock market may prompt a central bank to lower the interest rate to stimulate the economic activity, right? If the stock market is down, then what the government will do, what the bank will do, they will reduce the interest rate. Why? Already in the market, money is not there. They will reduce the rate of interest so that people will have more and more money in their pocket. If they have more money, people will spend money. People will invest money in the stock, right? So this is the action and influence on the monetary policy. And central bank monitors stock market trends as a part of economic assessment and using the information to guide the policy decision and impact the overall economic conditions. Now, next is the wealth effect, impact on the consumption, yes, and economic fluctuation. The rising stock price, the stock price is too high now, which can increase the wealth of the investors, and also leading to the higher consumer spending. Yes. So this phenomenon known as a wealth effect and can drive economic growth as increased spending stimulates demand for the goods and services. So spending will increase, demand will increase. Demand will increase, and the producers, manufacturers will produce more goods and provide more services. Economic fluctuation, if we say that economic fluctuation, conversely, that falling stock prices can reduce wealth, leading to the decreased consumer spending and potentially slowing economic growth. What is happening these days? Even yesterday, that was a Friday. Before the market closed, the market was around 10% down, which was a big down yesterday. Investment in innovative and infrastructure. Corporate investments and economic development is there. They invest money in the innovative and infrastructure for the growth of the economy overall. International capital flow, global market is there. Not only the US, Canada, but also the investor from all over the world. They buy stock, they sell stock. So the whole economy have interconnections, right? Not only one, but everything is connected. Cash flow is connected. Capital flow between the countries affect exchange rate, trade balances, economic relationship, and many things. So that is the international capital flow. Financial sector health, if we talk about the bank and financial institution, that I have explained about the Scotiabank, TD Bank, CIBC, Bank of Montreal, and RBC, and the health of the financial institution influenced by the stock market performance, and which impact their ability to lend and invest money. So stable financial sector also support economic activity, while instability can stop economic growth. So in nutshell, what we can say, the stock market play a very, very important role by facilitating the capital generation, reflecting the economic condition, influencing the monetary policy, impacting the consumer behavior. And understanding the relationship between the stock market and economic factors help the investors make informed decisions. And policymakers design effective economic strategy, just like whether to increase or decrease bank rate, whether to invest in the hospitals creation of the new hospitals and infrastructures, or maybe like a railway line, road lines. They are just going to maintain and build. All these money they will be going to spend. If the government spending increase, then unemployment will go down, because the manpower is required to complete these big projects, right? So what I say, I just would like to show you something practically now. Look at this, the Microsoft share price. If I say that in Google, we see the Microsoft price, and there are some days, the one day. Look at this, 3.56 is a very big down. But if I say in 5 days, and 1 month, 10%, 6 months, 12%. So 12%, Microsoft company have the 12% down. What does it mean? If an investor have $100,000 share, so $12,000 is down. So in this case, what do we think? Like, should we sell it? No. If we have bought it, no need to sell. Just wait and watch. YTD is year till date, means January till today, April 5th of April 2025. So 14% has gone down, big. But if you are a long-term investors, don't look at these things. Look at 5 years. So this is 133.95. So what does it mean? I'll show you. Let's say 133.50. And if it is 5 years, so look, 133 divided by 5, it means how much return? 26.17. So 26.17 is return every year. Every year. So 26.7 is every year, but this is return only and only the investor will get if the person will invest for 5 years or more. But if like in 1 year, like there will be a loss of 15. This is the loss that you can see. If it's a short term, like for a month or 6 months, again, there is a loss. But this time there is a loss because of the tariff. Otherwise, the market was going up. And just in the last month, the market is down. Now, for example, if you want to compare two stock, and there is one button you can see here, compare. Microsoft here, the Microsoft that you can compare with other companies. Let's say if you want to compare with Apple. So Microsoft and Apple. So look at this. The blue one is Microsoft, and red one is the Apple. So if we say 6 months, you can say 13%, 16% minus YTD. Apple have lost more money, more in and as compared to Microsoft. 1 year, Apple still have a positive response, like it's a plus, but this is Microsoft is down. 5 years, so 180, 81, and 117, right? So max is like, you cannot imagine what is this. It's a very big amount. But if we say about the 5 years, you can see the 5 years growth, right? This is how we can compare. If we want to compare with another companies also, and we can also compare and add more information here. Okay, so next I just would like to show you very important things. That is, now we have this information, but why we want to know all this? Why we want to know? The second, sometime that this is one PE ratio, price to earning ratio. It means that if Microsoft, now from these two, which one is cheaper? It's very difficult to know, difficult to tell. So which one is cheaper? But if we know the meaning of PE ratio, we can tell easily. So PE ratio says 28.99 and 29.95. It shows that if you spend $28.99 today, you will earn $1. It shows 29.95 you spend, you will earn $1. It means which one is cheaper? Microsoft is cheaper in this case. Let's take an example of we can We can compare with another company, Microsoft, and compare with, let's say, Tesla stock price, compare with the Microsoft. Then look at this. So now the Tesla has gone up drastically. And in 5 years, you can see 526% in 5 years, and Microsoft is 117. But what is the meaning of volatile? You can see the volatile. This is volatile, up, down, up, down, up, down, up, down, up, down. And Microsoft is not volatile, right? It's not volatile. It's growing, but slowly it's growing. But this is volatile. It's more risk, but here there is a less risk. So risk reward ratio. So more risk, more profit, less risk, less profit. Now look at this. P ratio says $117 if you spend in a Tesla, you will earn $1. And if you spend 28.99, you will earn $1. So spending this, you will earn same $1. Spending this amount, you will earn same $1. It shows that 28.99 is the better option if we compare these two. On the top, this is stable. And what is most important thing? Look at this. Again, Tesla and Microsoft. I'll show you one more thing. Okay, so let's say, so this stock is Tesla and Microsoft. Let's say Tesla and Microsoft. So let's say Tesla, if you say stock research, and you will find something here. Yeah, stock research, stock scanner, and we will find lots of stock. But let's say I want to see Tesla and Microsoft. Let's click on the Tesla first. And I just would like to show you the other ratio. Go to other ratio and you will find debt to equity ratio, right? So you can note it down on the paper. Point 0.08, 0.08. Okay, so this is for Tesla, right? So go back and again go back. So Tesla and Microsoft. Let's go to Microsoft other ratios, and in other ratios, the debt to equity ratio. Let's see how much it is. So this is a 0.13. Okay, so Microsoft and Tesla both have excellent debt to equity ratio. It means it should be less than 1, and obviously both ratios are less than 1. So less than 1. So less than 1 shows if the stock, if the debt to equity ratio is less than 1, it means company have less debt. Look at this. Long-term debt and equity. Debt is less and equity is more. But this is the debt to equity for this quarter, right? For this quarter, 0.79. It is less than 1. And this is I'm talking about for the Microsoft. Let's say let's go back to the Tesla. Let's go back to the Tesla. If I go back to the Tesla and I see here debt to equity ratio, and which is like 0.08. If we look at this, the Tesla is having like 0.66, 0.70, 0.68 in the last quarter. So last to last quarter, right? First, second, third, fourth quarter in 2024 and 2023. So which is really good, really good. Like, so debt to equity ratio is less. If the debt to equity ratio is more than 1, then there is a question. The question comes in our mind: should we invest or not? Now this is that how we can compare two stocks and which one is good, which one is not good. And the most is the margin. So look at the margin here. So what we will see, look at the margin here, gross profit, operating net profit, net margin. Okay, so go to the net margin and let's see how much is the net margin here. So this is a 7.3% net margin, mean net profit. So as we know that in the profit and loss account, the credit side is a revenue and the debit side is all expenses. So revenue minus expenses, all interest, depreciation, everything, then comes to the amount. That amount will be on the sale. So that is 7.3% net margin. Now look at the Tesla. It's a Tesla. Look at the Microsoft. Microsoft price ratio, other ratios, um, margins, net margin. Okay, so net margin here for this company is 35.43%, which is really good. With the company which have more than 10% of the return. Look at this, Microsoft company. So Microsoft company have a 35% profit. This is really good, really good. See, overall result from 2019, around more than 30, which is excellent performance by the Microsoft company. Excellent performance and steady performance. It's a steady. Every time it's increasing, little bit decrease, right? But overall that we can say more than 30%, which is excellent performance. Like if today market is down and this is the right time to buy, this is the right time to invest in the stock market. What I would say, this is the right time to buy stock. But which stock, when to buy, how to buy, this is also a big question. Now what I would say, I would like to explain you very important thing, very important. So just wait for 1 second. Okay, so now what I say, take an example, I delete it and take an example. If one thing is there, if we want to, if we have $10,000 and if the bank is giving 5% and 5% per annum, and then how many years it will take to double this money? This is the question, right? So to double this money, like 5% is like here a $500 in a year. So again $500 in a year, right? Again $500 in a year. So how many years it will take to double money? So how we can calculate? Sometimes we get confused how to do this, but there is a shortcut. What is that? 72. There is a rule. 72 divide by percentage. So what I say, let's say if I what I'm doing, let's say 72 and this is 10,000. Okay, so in how many years it will be double money? So 72 divide by 5%, not 5%, just 5. 14.4. What does it mean? It means the $10,000 if you deposit to the Scotia Bank or RBC Bank today, after 14.4 years it will be 20,000. Right? Why? Because this is 5% that we have here. It's a 5%, right? It's a 5%. Okay, if for example, like this is a 5% return per year, if that is a 6%, then that it means it will be 12. If it is a 7%, it will be 10 years. If it is a 10%, it will take a 7.2. If it is like 15%, it will take 4.5. If it is 18%, it will take 4 years. My dear friends, now I would like to give you excellent information. Always look for the investment which will give you at least 18%, 15 to 18%. So what does it mean? It means like if you spend 10,000, it will be double in 4 years. It will be double in 4 years if it is 18%. Right? So okay, I'm just what I'm thinking now. Let's say initial investment is $100,000. Initial investment $100,000, right? And I keep this for let's say 4 years, right? When it will double, if I'm considering 18 years, it will be double here in 4 years. It will be double, right? So this is 10,000, and if it is double, it means into 2. So whatever that we have invested into 2, so that will be doubled. Again, if I think like this is double in how many years? 4 years. 4 years, right? It is 4 years. If this is 4, if this is 4, and this will be into 2, like 4, and this will be into 2, means 8 years. Like if you spend $100,000 today, means like today, first 0 year, and after 4 years, it will be $200,000. Again, that you keep on investing this money, and then what will happen? So this money will double in 8 years. Now, if this is 8, so it means again that 8 plus 4. So 8 plus the 4 year again. It means next 4 year, like because we are considering the 18%, because 18% says that the money will be doubled in 4 years. So this $400,000 into 2, that will be $800,000. If again I invest this money for next 4 years, this 800,000 will be doubled, and it will be one, not 80 lakh, but it's 800,000. It's 800,000. Now this is 1.6 million. 1.6 million, right? So like again, if we say that 16 years, then plus the 4 year here, and what I say that 1.6 will become the 32, right? So it means $3.2 million, right? Again, if I think like so 20 plus 4, again after 4 years, if I think like 3.2 will become the 6.4 million, right? So if it's a 32 lakh, 64 lakh, right? So if again I think about the 4 years, now what will happen? So this money will be double, and this will be 10 million. 12.8 million, not 1 million, it's 12.8 million, right? This much of amount. And if you have this much of amount in 28 years, let's say some people say that those who are very risky, just like I'll show you one thing. Look at this, and this is the individual stock. Some people spend in an individual stock, right? So what does it mean? Just for the 5 years is 502%. 502%. So 502, let's go to Excel. If it is a 502, and this is for 5 years data, and if I say how much is the return every year on an average, 100%. If I put 100 here, look at the figures. If put a 100, so it means that 100,000 that if you spend, and it will be in 5 years. In 5 years, it will be 128 lakh. If it is 100%. 100% is very rare because no doubt it's more risky stock. Tesla stock is very good, but it's more risky. Now I can compare not only this, but I just would like to go to Costco. Let's say the Costco price, and in 5 years it's at 217, which is very realistic. Costco company is not going to die. Microsoft is not going to die. Even Tesla is not going to die. Yeah, the Tesla, like Elon Musk, the richest person in the world, right? It's not going to die. So look at this, like 217. Go to Excel. So 217, 43%. Let's say if I write here 43%. Look at this. So it means if you spend $100,000 today, in 11 years, just for example, your age is 20 years. When you will be 30 years, you will have 128 lakh Canadian dollar or US dollar, whatever you have. It's not a small amount, it's a very, very big amount. But you need to spend. Now, the question arises, this thing that you have understood, but the question arises, how we can come to know, and without risk, that if we want to earn profit, that where to invest. So now look at this, go back. If this is the individual stock, if individual stock is there, no doubt this is really very good growth, very good growth. This time, look at this, market is 12%, 12% down. Market is 12% down for the Costco. See, let's say I say I want to buy Costco, I want to buy Microsoft, I want to buy Nvidia. So let's say Nvidia. So Nvidia is the stock, like Nvidia is the company, and which I'm telling you is American company, right? So this is related to, it's related to like all the software and all chips. It's a chip making company, Nvidia. Competitors of Nvidia is AMD. Like, but performance-wise, Nvidia is performing well, and it was founded in 1993, right? So Jensen is the owner of this, like he's the founder, and listed in the stock exchange Nasdaq. It's in the California headquarters. So the main business is GPU, like graphical processing unit, data processing, AI, right? And also that is automobile sector, software performance, right? Gaming technology. So all these are AI chip market. It's like $1 trillion company, right? It's not a small company, it's $1 trillion company. Now, what's the price of this today? Look, if I say the 1 month is 20% down, the market is crashed these days. It's almost crash, almost crash. Even I have stock and my stock is very low. But what I'm thinking, I'm not going to sell it. I'm just planning to buy more. But I'm not investing. I'm not investing in one stock, Nvidia, Microsoft. No, the basket of stock. What I think, I'm just going to invest in triple Q. What is a triple Q? So triple Q is also here. Look at this. It's 12%, 15% down, which is big down, 15%. Year till date is 17%. 1 year, 4%. 5 year, 130. If you invest here in 130, this is conservative. If you invest in a triple Q, it's not a volatile. Its growth is always going up, 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 down, up, down, up, down. The trend is up, right? So let's say 5 years, 130. Go back to the Excel, 130. 26. So if I write here 26, or not 26, if I write here 26 like this, look, if you spend $1 lakh here today, after 11 years, 160 is 1 lakh, 2 lakh, 4 lakh, 8 lakh, 16 lakh dollar. And in like 20 years, 128 lakh. So it means 12.8 million. 12.8 million. It's like 64 lakh. 64 lakh, right? It means 64 lakh mean 6.4 million, 3.2 million, 1.6 million. It's a 1.6 is a 12.6, 12.8 million. So the person will be a millionaire, right? In 20 years, but provided if you have $100,000. Let's say if you not have 100, just let's say somehow you have arranged $10,000. But even then, like 1.28 million. So look, 64,000, 640,000, 1.28 million, right? So 1.28 million, which is not a small amount. Just if you have $10,000, provided if you keep that stock for 20 years in triple Q. And there is one more T triple Q. This is also ETF. Okay, so ETF here is look at this. So this is down by 40%. If the triple Q and the T triple Qs are same, but this is multiplied by 3. If the market is down, it will go 3 times down. If the market is up, it will go 3 times up as compared to the triple Q. Right? So this is the T triple Q. And if I compare with the triple Q only, then you will find the difference. Look, in 1 year, so this is volatile, more volatile, and this is stable. Red is stable here. This is triple Q, this is T triple Q. So now market is down, look, but this market is more down. When market is little up, this is more up, down, more down, but this is 3 times. So that's why this is known as 3-time leverage. 5 years, look at the 5 years. No doubt, if triple Q is 110% and it is 200%, it'll go back to the Excel. If it is a 110% today, so 110, even then this is 22%, which is really good. I'm telling you, more than 15% steady or 15 to 18% is excellent according to the Warren Buffett. According to the Warren Buffett, right? So look, see, volatile, and this is stable, slowly, just like a rabbit. This is just not rabbit, it's a tortoise. This is a rabbit, right? Up, down, up, down, up, down. Now market is down, too much down. So this is the right time to buy something. So there are some softwares that I will send you a list of these applications, which is reliable. I'll send you, and I will let you know how to how to install and how to invest money and where to invest money, right? So that criteria I'll let you know in the upcoming session. So this was just introduction to little stock market comparison, how we can see. So why we see this? We see that we want how that money can be doubled, right? If it is 22%, it is doubled in around 3.27 years. This is years, right? So here that we want to see the long term. If I say, if for example, I normally invest in T triple Q, right, which is risky. which is risky as compared to triple Q, right? But let's say if it is risky, then 220% is a 44, which is really good. It means that I will be double my amount in 1.5 years approximately. In 11 years, I will have this much of money. 12.8 million. If I spend $100,000, if I spend $200,000, then today I will be having 256. I will be a millionaire. I'm telling you, I will be a millionaire. Right? So look at this. This is not a hypothetical things. This is the real picture I'm telling you. This is the reality of life. I have been investing and I have been using this one for the long period of time. I'm using this strategy. I always look for the long term. I don't do trading, day trading. I think like we should do day trading, but I don't do that. I don't have time. I am an investor. All time I am a buyer. I don't sell stock. I have been buying stock for last 10 years. Slowly. I was buying stock in India. I bought like India many stocks and I sold that all stocks and I bought it here. I have individual stocks. I have ETF. I did not buy a mutual fund. And I'm earning a very good amount of money, right? So sometime I lost. So about the cryptocurrency, what I would say, if you have some money and you want to put in the and you are ready to put in the garbage, for example, $20 that you want to put in the garbage, and you will say, okay, that has gone and gone. So invest in that cryptocurrency, right? But in cryptocurrency, whatever you buy, it from the like $200, it can be $20,000 just within a year. But the $200, if you're ready to lose $200, invest in cryptocurrency, right? This is any cryptocurrency, maybe Bitcoin, Ethereum, or XRP, or there are lots, Shiba, there are lots of there. Anything, just you study. But the thing is, if you invest, think that this money has gone. If it is zero, don't repent, don't contrite, don't remorse, right? Okay.